Something strange is happening in silver dealerships across America, Europe, and Asia, and most people have no idea it's even occurring. In October 2025, if you walked into a coin shop to sell your junk silver, those pre-1965 90% silver dimes and quarters sitting in your drawer, dealers would pay you close to spot price, maybe 95 to 98% of melt value. That's how the market has always worked. But in November and December, those same dealers stopped buying completely. Or if they did buy, they offered you 50, 60, sometimes 70% below melt value. At the same time, if you wanted to buy silver, premiums that used to run $3 to $5 over spot for generic rounds suddenly jumped to $12, $15, even $20 per ounce. American Silver Eagles that traded at $6 over spot now command $15 to $18 premiums, a 50 to 300% increase in dealer markups overnight across the entire industry. This isn't price gouging. This is a market breaking in real time, and the data shows exactly why it's happening and what it means for anyone holding or considering buying silver in 2026. Let's break down what's really going on behind the counter. To understand why dealers suddenly stopped buying silver, we need to talk about how the physical silver market actually works. Because it's not as simple as you think. When you sell silver to a dealer, they don't just stick it on a shelf and hope someone buys it. Most dealers immediately send that material to a refinery. Why? Because 90% junk silver, sterling flatware, and random silver rounds aren't what the big markets trade. The London Bullion Market Association and COMEX trade 1,000-ounce good delivery bars of 999 fine silver. So refineries melt down your coins, purify them to 999 fineness, cast them into those standardized bars, and sell them into the wholesale market. The dealer gets paid once that process completes, usually within a few weeks. Here's the key part. Refineries don't pay cash up front. They borrow silver or cash from bullion banks at something called the lease rate to finance the metal while it's being processed. Think of it like an overdraft or short-term loan. Normally, lease rates run 1 to 3%. That's manageable. But in October 2025, silver lease rates in London exploded. We're talking 80%, 100%, even higher for short-term borrowing. According to Gold Traders UK, a precious metals dealer in the United Kingdom, these rates made it uneconomical for refiners to accept and hold new material, as the financing costs wipe out any potential profit. When refiners can't afford to borrow the metal they're processing, the entire supply chain freezes, and that's exactly what happened. According to SD Bullion, one of the largest online precious metals dealers in North America, in late October 2025, major dealers announced they would no longer purchase junk silver or scrap silver for melting. Not because they didn't want it, because refineries literally stopped accepting it. CoinWeek, a leading numismatic news site, described the situation as an unprecedented liquidity crisis. They documented how wholesalers and larger bullion dealers who rely on refiners to process high volumes of scrap silver could no longer afford to buy junk silver at usual close-to-spot rates. Gold Traders UK was more blunt in their customer notice, posted in October. Exceptionally high silver lease rates have created a temporary liquidity crisis in the global silver market, forcing refiners to pause normal trading and advance payments. We're still accepting silver, but can't currently buy it at our usual market rate. This disruption is industry-wide. Let me repeat that. Industry-wide disruption. Not one refinery, not one region, the entire global silver refining system. Meanwhile, according to AO Bullion, a Canadian dealer, the world's largest refiners, Valcambi, Arger Heraeus, Perth Mint, Asahi, and Johnson Matthey, were all quoting 10 to 14-week delays for new 1,000-ounce bars. That's up from the normal 2 to 4 weeks. 10 to 14 weeks, to get a silver bar in a market that's supposed to be liquid. So why did lease rates spike in the first place? The answer is simple. There's not enough physical silver to go around. According to AO Bullion's December 2025 report, titled Silver Shortage 2025, the physical squeeze in plain numbers, the evidence is overwhelming. Shanghai vaults, the Shanghai Futures Exchange and Shanghai Gold Exchange combined, held 189,648 kilograms of deliverable silver on September 30th, 2025, right before China's National Day holiday. By November 23rd, only $519, 271 kilograms remained. That's a 56.35% drawdown in just 51 days, over 21 million troy ounces gone in less than 2 months. And here's the kicker. On November 21st alone, another 15,819 kilograms was removed despite the spot price falling. Think about that. Price drops and physical demand accelerates. That's the exact opposite of how a normal market behaves. It's a classic sign of shortage. Chinese solar manufacturers, electronics fabricators, and state entities are taking every kilo they can get while it's still available. In London, the situation is even worse. According to O'Bullion, the LBMA's true free float, the physical silver immediately available to settle London's vast unallocated accounts, collapsed to an estimated 155 million ounces in October. That's barely 6 weeks of world consumption. Bid-ask spreads in the London market exploded from pennies to $6 to $8 per ounce overnight. Silver lease rates spiked above 7%, levels not seen since the 2008 financial crisis. Several Tier 1 bullion banks simply withdrew all offers. One senior LBMA market maker told Reuters anonymously, "There is no offer anywhere, only desperate bids." Translation: people want to buy silver, nobody wants to sell, because there isn't enough to go around. For the first time in modern history, the three largest transparent silver inventories, Shanghai, COMEX, and LBMA, are all draining at the same time, at record speed. The Silver Institute, the industry's main research body, reported in November 2025 that the silver market will post a 95 million ounce deficit in 2025. That's the fifth consecutive year of supply shortages. The cumulative deficit from 2021 to 2025, nearly 820 million ounces. That's 820 million ounces consumed but not replaced by mining or recycling. And here's why it won't get better anytime soon. 70% of global silver production is a byproduct of copper, zinc, and lead mining. Those mines respond to their own metal prices, not silver's. Primary silver mines account for less than 25% of supply and require 7 to 10 years from discovery to production. Translation: there is no quick supply fix coming. O'Bullion puts it starkly: global mine supply in 2025 will be essentially flat at approximately 820 million ounces, while total demand approaches 1.2 billion ounces, the fifth consecutive calendar year deficit. When demand exceeds supply by 380 million ounces per year, and that's been happening for 5 years straight, eventually you run out of inventory. And that's exactly what's happening in Shanghai, London, and New York, all at once. So what does this mean for premiums? Wholesale physical premiums, the markup that dealers pay over COMEX spot when buying 1,000-ounce bars, used to run $1 to $2 per ounce. According to O'Bullion, those premiums jumped to a sustained $6 to $10 per ounce by late 2025. That's the wholesale level, before it even gets to retail. At retail, the situation is even more dramatic. According to Gainesville Coins, a major U.S. dealer, reasonable premiums used to be 5 to 10% over spot for generic rounds. That would be maybe $3 to $5 per ounce when silver was trading at $50. By December 2025, with silver at $70 to $80, retail coin and small bar premiums in North America and Europe routinely exceeded $12 to $15 per ounce on generic rounds and $20 plus on recognizable products like American Silver Eagles or Canadian Maples. Let's do the math. If spot silver is $75 and you're paying $90 for a Silver Eagle, that's a $15 premium, 20% over spot. Compare that to the historical 8 to 10% premium. That's a doubling or tripling of markups. Multiple U.S. mints and European dealers instituted allocation limits or outright suspended sales of certain items to ensure future supply. The U.S. Mint itself produced 363,000 one-ounce Silver American Eagles in January 2025. By July, that dropped to just 305,000. No month since May saw more than 600,000 produced. The official reason? Supply constraints. The most popular silver coin in the world. Supply constraints. Now here's the other side of the equation. While dealers can't sell you silver fast enough or cheaply enough, if you try to sell your silver back to them, good luck. CoinWeek documented this paradox in their report, The Silver Freeze, Refining Backlogs. Create a liquidity crisis for junk silver. They explain, for the retail investor, the primary consequence is a sudden and sharp reduction in liquidity. Junk silver is historically popular precisely because of its high liquidity and fractional size, making it easy to sell small amounts. Now, the traditional avenue for liquidation, selling back to a dealer, is choked. Retail sellers who managed to find a dealer willing to buy were receiving offers significantly lower than expected. We're talking 50 to 70% of melt value in some cases. Why? Because dealers can't send that material to refineries. They're stuck with inventory they can't convert to sellable product. Meanwhile, ironically, for those still looking to buy junk silver, premiums increased. The existing stock held by dealers became more valuable as a finished fractional product, given the difficulty and delay in converting new scrap into refined forms. So you have a market where dealers are simultaneously desperate to sell you silver at high premiums while refusing to buy yours back at reasonable prices. That's not a healthy market. That's a broken market. Let me be clear about what this means for the paper versus physical disconnect. For years, silver investors have argued that COMEX prices are suppressed by paper trading that has no connection to physical reality. The refining crisis of late 2025 provides the most compelling evidence yet that they're right. When you buy a silver futures contract on COMEX, you're not buying physical silver, you're buying a financial derivative, a promise of future delivery. Most of those contracts are settled in cash, not metal. According to Owl Bullion, the paper-to-physical leverage in London is now conservatively estimated north of 300 to 1. That means for every ounce of physical silver in LBMA vaults, there are 300 ounces worth of paper claims. That works fine until people start asking for actual delivery. Gold Traders UK explains it perfectly. The way the market is structured, with a handful of large institutions controlling both physical inventories and paper trading, means that when those players pull back or tighten lending, the effects can look very similar to manipulation. Prices move sharply, liquidity dries up, and smaller participants are left waiting for normal service to resume. Shanghai's physical market trades actual deliverable silver. When you buy on the Shanghai Gold Exchange, you can take possession of real bars. That's why Shanghai Premium stayed elevated even when COMEX crashed. Physical always wins eventually because you can't print silver. Now let's talk about where this goes in 2026. According to Scottsdale Bullion and Coin's comprehensive forecast analysis, expert projections place silver's average 2026 price near $97 per ounce, with a consensus range of $65 to $100, and high-end outliers reaching $200. But here's what matters more than price predictions: structural supply stress. Gold Traders UK notes in their analysis, until the refining logjams clear and, critically, the silver lease rates return to sustainable levels, the illiquidity in the junk silver market is likely to persist. This event underscores a fundamental reality in the precious metal space. The value of physical metal is not just its spot price, but its convertibility. Read that again. The value of physical metal is not just its spot price, but its convertibility. If you can't convert your silver into cash or trade it for something else, it doesn't matter what spot price says. What matters is what someone will actually pay you. Right now, that disconnect is widening. Spot silver might say $75, but try buying a silver eagle for less than $90. Try selling your junk silver for more than 60% of melt. The paper price and the physical price are in two different universes. Owl Bullion summarizes the situation with brutal clarity. For the first time in modern history, the three largest transparent silver inventories, Shanghai, COMEX, and LBMA, are all draining at the same time at record speed. Nearly 1 billion ounces of refined silver have vanished from visible stocks since 2021. There's no quick fix, no new mines, no spare metal. When the last readily available bar leaves the vault, the price discovery mechanism flips from whatever the paper market can bear to whatever it takes to pry the last ounce out of private hands. They conclude, 2025 is not a correction. It is the year the physical silver market broke, and the countdown to rationing by price alone has already begun. Let that sink in. Rationing by price. Not because silver is worthless, because there isn't enough to go around. So what should you do with this information? First, understand what premiums actually mean. A premium isn't just dealer markup. It's a measure of supply stress. When premiums double or triple, the market is telling you something. It's saying physical metal is harder to get than spot price suggests. Second, if you're buying silver, focus on products with the lowest premiums that are still liquid. Generic rounds and bars from reputable mints offer the best value. American Silver Eagles and Canadian Maples have higher premiums, but also higher resale liquidity. Third, if you're selling silver, be strategic. The refining crisis may ease in Q1 or Q2 2026 as lease rates normalize. If you don't need immediate cash, waiting a few months could mean the difference between selling at 60% of melt versus 95% of melt. Fourth, recognize that this is exactly what supply shortages look like before prices explode. In 2020, when COVID hit, silver briefly spiked to $30 and premiums went insane. Then spot prices pulled back, but premiums stayed elevated. Then in 2024 and 2025, prices launched to $50, $60, $70, and beyond. The pattern is physical stress shows up first in premiums and availability. Price follows later. And right now, physical stress is off the charts. Gold Traders UK ends their customer notice with this. We want to be completely transparent. We are still accepting silver. You can send or bring in your scrap silver as normal. We cannot currently buy at our usual market rate. Because refiners aren't advancing payment to us, the market for scrap silver has effectively slowed down. We continue to pay promptly for gold. The gold market remains liquid and unaffected by these financing issues. As soon as conditions normalize, our rates will be restored. That's a reputable, established dealer telling you in plain English. The silver market is broken. Gold is fine. Silver is not. CoinWeek sums up the implications. This situation reveals the underlying stress in the physical silver market, where a convergence of high demand, dwindling above-ground stocks, and financial constraints has exposed a critical vulnerability in the global refining infrastructure. Critical vulnerability. That's not hyperbole. That's market structure failing under stress. Let's bring this full circle. Silver dealers quietly raised prices 50 to 300% overnight. Not because they're greedy, because they can't get supply. Refineries stopped accepting material because lease rates made it unprofitable. Lease rates spiked because there's not enough physical silver in vaults to satisfy demand. 5 consecutive years of supply deficits totaling 820 million ounces. Shanghai vaults down 56% in 7 weeks. London free float at 6 weeks of consumption. Refinery delays stretching to 14 weeks. Premiums doubling and tripling. Dealers refusing to buy junk silver. These aren't isolated incidents. This is a system under extreme stress. And the data suggests 2026 won't bring relief. It will bring resolution. Either new supply comes online, which takes years, or demand backs off, which seems unlikely given industrial needs for solar, EVs, and AI, or prices rise high enough to ration remaining supply. All Bullion's final line says it all. When the last readily available bar leaves the vault, the price discovery mechanism flips from whatever the paper market can bear to whatever it takes to pry the last ounce out of private hands. 2025 is not a correction. It is the year the physical silver market broke, and the countdown to rationing by price alone has already begun. If you're waiting for silver to get cheaper before you buy, you might be waiting forever. If you're hoping dealers will pay you full melt value for your junk silver, you need to understand the refining system is jammed. And if you think spot price tells you what silver is really worth, look at what people are actually paying and what dealers are actually charging. The market is sending a signal. The question is, are you listening? What's your take? Have you noticed premiums skyrocketing at your local coin shop? Are dealers refusing to buy your silver? Drop your experiences in the comments below. And if you found this deep dive valuable, hit that like button and subscribe. We'll be tracking this silver supply crisis throughout 2026 with regular updates. Because what's happening right now isn't just a story about premiums. It's a story about what happens when paper markets collide with physical reality. And physical reality is winning. Until next time, stay curious, stay informed, and remember, in silver markets, the premium is the price. Everything else is just noise.